Marvell's trading at $75 right now, and analysts think it could go up as high as $149. That's a 98% upside, but no one's talking about it. And when Wall Street's whispering, but retailers not listening, that's usually when the biggest opportunities or the biggest traps appear. My name is Rick Orford. I've been trading since 1999, and I'm not a financial advisor, and that's a good thing because that means I'm not here to sell you something that you don't need and call it a day. No, I break down the real numbers and analyze real opportunities for retail investors like you and me. And here's what I'm here to tell you. Marvell just posted a 63% revenue and 180% profit growth on GAAP numbers, not adjusted, not non-GAAP, no smoke or mirrors, just raw, clean profit for the second consecutive quarter. And that's the kind of streak that turns heads on Wall Street. But strangely, this one is flying under the radar. Now, they've locked in deals with Nvidia and Amazon. They're powering 76% of their revenue from data center demand alone. And yet the stock's still trading at a cheaper multiple than Broadcom, AMD, and Nvidia. But there's a catch, and it's a big one. Marvell's clients today may turn into their biggest competitors tomorrow. And if that happens, the upside that everyone is dreaming about could evaporate overnight. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/ricko to get your 10 stock picks right now. In this video, I'm going to break down the numbers, the upside, the risk, where I think the stock is going. And it's probably not what you're expecting. So let's get into it. Now, before we dive into the price action, let's make sure we actually understand what Marvell does, because that's where most people get it wrong. Marvell is a semiconductor company that designs and develops high-performance chips and other related products for AI data centers, cloud computing enterprises, and more. The company operates through 5 segments: data centers for AI accelerators and cloud computing products, enterprise networking for Ethernet switches and edge computing, carrier infrastructure for 5G and wireless connectivity, automotive and industrial, and consumer. Now, I know that many people are familiar with the big names, right? Like Nvidia and AMD when it comes to AI semiconductors, but Marvell isn't really like them. Think of it this way. If a data center were a body, Nvidia and AMD would be the ones supplying the brains and other critical organs, while Marvell provides the nerves, the arteries, and other connective tissues. And this, I think, is why investors, or at least some, are sleeping on Marvell and similar companies. They may not be as big or as frequently featured in the news like Nvidia, but their roles are essential in the AI and cloud ecosystem. And in tech, sometimes the quietest players end up controlling the most valuable choke points. Now, here's where things get interesting, because the chart tells a story of pain and a potential comeback. Now, if you want to follow along as I go through the company's stock price, just scan this QR code. This year has been a roller coaster for Marvell's stock price. After peaking at $127 last January, the stock went on a free fall ending at $47.08 in April. That's a 63% drop in 4 months. Good news is the stock is up over 61% from that 52-week low today. On a longer time frame, Marvell is up 126% over the last 5 years and over 568% in the last decade. But let's have a look at its recent rally to find out where that all came from. And to do that, we need to check the company's financials. This is where Marvell went from a meh to a must-watch. Marvell reported its first quarter results for the fiscal year 2026 back in May, And it was exactly what investors were waiting for. Revenue grew 63% year over year, reaching $1.9 billion, while diluted net income came in at 180% higher at 20 cents per share. Now, this may not seem like a big deal, but Q1, well, positive results mean the company has reported solid profitability for 2 consecutive quarters on a GAAP basis. Now, here's a quick finance lesson for you. GAAP, or Generally Accepted Accounting Principles, means the numbers follow strict accounting rules. There's no removal of one-time or surprise charges, no adjustments, just the raw numbers. Now, non-GAAP means the values are adjusted based on management's judgment. So when a company crushes it on GAAP, that's when I sit up and pay attention. And on the heels of Marvell's excellent performance, analysts are expecting next quarter's bottom line to also improve significantly year over year. The company itself forecasts $2 billion in revenue for the next quarter. And we don't even have to wait that long to find out. Marvell will be releasing its Q2 financials on August 28th. Analysts are so optimistic about the stock that they've issued Marvell a high target price of $149, representing a massive potential of 98% upside. And big upside targets like that usually come with big risks, and we're going to get to those in a minute. Now, let's talk about what could keep this rally going. Well, the most obvious answer is the growing demand for AI and data centers. And this is something that we've discussed recently over in my Discord channel. Marvell's data center segment accounted for 76% of its Q1 revenue, and by the looks of things, it's only going up, barring one potential caveat that I'm going to get to in a little bit. The company is successfully targeting hyperscalers, sovereign data centers, and emerging markets with silicon solutions and high-speed networking tech that's custom-made for different workloads. And with more countries building their own AI infrastructure, Marvell's position becomes even stronger. Another great thing about Marvell's products is its customizability that comes with them, which makes them a perfect partner for other AI tech providers. Unlike off-the-shelf solutions, the company works with its clients to develop silicon solutions that are tailor-made for specific workloads. And let me tell you, it seems to be working very well. Last year, Marvell expanded its collaboration with Amazon to provide a whole range of products from optical processors to Ethernet switching silicon solutions. The company is also working with Nvidia on its NVLink Fusion platform, which combines Marvell's custom silicon and networking expertise with Nvidia's high bandwidth chip-to-chip interconnect technology. And this enables cloud providers and hyperscalers to use Marvell's custom auxiliary processing units, or XPUs, with Nvidia's top-shelf GPUs. In other words, Marvell is wiring itself into the beating heart of the AI boom. Marvell's other advantage is its relatively cheap valuation, and you have the massive price drop to thank for that. Currently, the stock is trading at around 35 times future earnings. In comparison, Broadcom is trading at 53 times, AMD 56 times, and Nvidia at 44 times. And that makes Marvell look like a relative bargain, especially considering it's playing in the same AI-driven growth space. This works for both value and growth investors. Cheap valuations, high potential upside, and of course, exposure to AI. And when you can get growth at a discount, well, that might just be the holy grail of investing, at least on paper. But every great story has a but, and Marvell, well, they have a big one. One of the biggest concerns that I have for Marvell's prospects is the ongoing US-China trade war, especially with potential trade restrictions down the line. We've seen this with the US kneecapping of the likes like Nvidia and AMD by tightening export controls on high-performance GPUs to China. If you recall, Nvidia took a $2.5 billion revenue hit, while AMD lost out on $800 million. Now, There have been compromises made, and everything is changing practically every day, mostly by just allowing watered-down versions of Nvidia's more powerful chips for the Chinese export market. But at the end of the day, uncertainty remains, and things change, right, all the time, which leads to volatility in the tech sector. Should the US extend restrictions to custom silicon or networking products, Marvell's limited access to the Chinese market could have a massive impact on its profitability and, more importantly, its growth prospects. Another potential issue here is the future competition, and by competition, I mean Marvell's current clients. The company is working with big names like Amazon, Meta, Broadcom through VMware, and previously with Google, and many more other companies. These companies are growing alongside the AI boom. They're not short on resources, and with the right incentive, they could vertically integrate and develop their own custom silicon, and that's the problem. This is a big problem for third-party solution providers like Marvell. And the even bigger problem is we're already starting to see it happen. Amazon already has 2 in-house custom chips, Graviton and Trainium. And of course, Google, they have Ironwood, its first cloud tensor processing unit. And now even Meta is working on its own custom inference chips. With these developments, all 3 companies are aiming to reduce reliance on third-party vendors. If this trend continues across the sector, it could chip away, pun intended, at Marvell's future market share. It would have to match price points with in-house development, and that's never an easy feat, while maintaining quality products and services to keep its clients. And that's the kind of margin squeeze that can turn a strong growth story into a bit of a slow bleed. Marvell currently has a consensus strong buy rating from 33 analysts with a high target price of $149. And I agree to some extent, but I'm a little bit more cautious than some. So I'm more inclined to rate this a moderate buy with a high price target of around $100 or about 46.5 times its projected non-GAAP EPS for fiscal 2026. Admittedly, I think that's a little bit stretched, but this accounts for the strength of the ongoing AI demand, along with the risks and uncertainties it's facing. In short, I see the upside, but I'm not betting the farm on it. But what do you think about Marvell? Are you bullish on the company? Are you buying into their vision? Let me know in the comments below. And while you're there, don't forget to hit the like and subscribe button so others will find this video as well. Thank you so much for watching, and I'll see you next time.